Welcome back. Two big stories of the morning, the tax bill and the big news, CVS official, making it official, reaching an agreement to acquire Aetna, a $69 billion deal in cash and stock. Joining us right now is Mary Ann Bartels. She's head of portfolio strategy at Merrill Lynch Wealth Management. And Mary Ann, one of the groups that you like is healthcare.
Absolutely. Under our Transforming World theme, we've been talking about healthcare because we have 80 million baby boomers that are aging. And so we think the supply and demand is going to favor healthcare over a longer period, and seeing mergers, especially big ones like Aetna and CVS, are just a sign and a symbol of how companies, I think, are trying to position for long-term growth.
You still like this market, even after $6 trillion in wealth creation since the election?
I just don't like it. I love it, Maria. I think
you love it.
I love it. I think people are totally underestimating how high risk assets can still go. Everyone still talks about how expensive the market is, but that's never a reason for the markets to go down. What really causes the markets to go down is something to stop growth, and everything that we're seeing in the marketplace is really talking about economic growth still occurring in 2018. We don't have any signs from the bond market that we should get any type of bear market behavior, which is down 20% or more. In fact, we recently at the firm just looked at the global yield curve, and the global yield curve is a great predictor of what markets do, and where we're positioned on the global market is for cyclicals to outperform.
I saw you guys on growth were, I think, at 2.2%, right, for real GDP, and 2.4% next year, 2.2% this year, 2.4% next year, but you didn't include tax reform in your estimates, presumably because there wasn't much clarity or you didn't really know what was going to happen. So now that we're working our way through this, I know we don't have a final bill yet, but what are the ranges growth-wise, you think, in terms of tax reform and how it could change that calculation?
We could add up to 0.4% to that number going into 2018.
So 2.8.
Correct. Around 2.7, 2.8.
By the way, I have a report here from J.P. Morgan Equity Strategy that says once the bill becomes law, 8 to 9% earnings growth for the S&P 500. 8 to 9% earnings growth on top of what has been a really strong quarter for earnings.
And Maria, we have already written that. We wrote that earlier this year. So
8 to 9% earnings growth?
We're in the camp of around 8% growth to earnings. And that,
S&P 500.
That is
for
correct.
2018.
Correct. So people are underestimating the power of how much higher this market can go. And obviously, I work on the wealth management side, and I talk to a lot of our clients. You would be amazed how many clients still have cash reserves that can come into this market.
I just want to be sure I understand this. So the market is up double digits into the 20%, depending on which market you look at. Are you saying we can get another year like that again in 2018?
Well, the way I look at it is, what are the chances that the markets are down 20% versus the chances the markets are up 20%? Just doing tails, right? I don't see a down market. So my answer is the market has to be up. It's a matter of how much the market's going to be up next year.
What about the political risk, though? At least that there was an erroneous report from Brian Ross at ABC News on Friday. Again, he's been suspended for 4 weeks for that. But you saw the markets really take a notch down on Friday. It's hard to invest based on potential political risk, but again, how do you create some ballast on your portfolio as these, as this Mueller investigation progresses?
You want to know, that's why a lot of our clients are on the sidelines, is because of the political backdrop.
Really?
Particularly because of what's happening in North Korea. There is concern there. Politics tends to be one of the first questions I get. The second question is what about the deficit? Those tend to be the major concerns of individual investors. And of course, we always say that you can't plan on the political side.
But you're optimistic because you think that money can come back off the sidelines, those people that you're talking about.
Oh, absolutely. I think people are underestimating how much money is on the sidelines. And I think the other thing that we keep forgetting is interest rates around the world remain at historic low levels.
Well, that's actually the worry, because the last 2 recessions began with the bursting of bubbles. The tech bubble back in 2000, which, because it wasn't debt related, it was kind of contained to one part of the economy, but then the bursting of the housing bubble. Maybe this is the debt bubble, the treasury bubble.
Well, we don't. So far, we don't necessarily see a bubble, and we've studied the 30s and the 40s. When you have a financial collapse of a mass proportion, of which we did in 2008. You just keep interest rates low for an extended period of time. And of course, the Fed was much more aggressive than the 30s and the 40s. But really what's happening is the policy in Japan and Europe is even that much more aggressive. And Europe is still printing money. And I learned a long time ago, you don't fight central banks. And what we don't also talk about is there are certain central banks that are actually buying global equities.
Yeah. Don't fight the Fed.
Don't fight any central bank.
The central banks are starting to pull back in other parts of in other places in the world right now. The ECB, for instance, is talking about winding down its bond buying programs. Does that pulling back have any effect on the markets that you talk about?
Based on what we've found, because we're in new territory, as you know, we've never seen these type of policies before, but based on how the U.S. is reacting, based on how the Fed has been raising rates and is expected to slow down their balance sheet, we haven't seen a material impact in the equity markets. And companies, again, we go back to corporate earnings.
Yeah.
And based on our work, not only are corporate earnings going to be positive here in the United States, they're positive globally.
By the way, we've got a November jobs report coming out this Friday. We just had 2 quarters straight, 3%, 3.3% last week on the GDP. You think we'll see more 3% quarters? And what's your expectation for the November jobs number out Friday?
Well, I don't know if we're going to change our number. I have not talked to our economists.
198,000 is the estimate.
But based on what we're looking at in terms of the tax bill, if the tax bill goes through somewhat like where it is right now, it can actually create job growth and start seeing the unemployment rate start falling to a 3 handle.
Wow.
Can the economy
break
bear
4.
a 3-handle unemployment rate? When we've gotten an unemployment rate that low in the past, it's tend to cause the kind of excesses that Dagan was talking about earlier. We had bubbles in the late 1990s and the mid-2000s when we had 3% plus unemployment rates. When do we have to start worrying about these markets getting overextended?
Well, there's 2 ways to look at it. From a cyclical standpoint, maybe in 19, but from a secular basis, not at least for another 10 years.
Wow.
Back up the truck and buy for the next 10 years.
Back up the truck and buy.
Back up the truck and buy for the next 10 years.
I like how bullish you are. Back up the truck. Mary Ann Bartels, you go, girl. Thank you so much for joining us this morning, Mary Ann.
Thank you.
Good to see you. Mary Ann Bartels, Merrill Lynch.